A critical structural shift is quietly destabilizing the global technology services sector. The market has been heavily focused on short-term margin fluctuations, completely overlooking a massive macroeconomic double whammy. On one side, sweeping policy changes out of Washington threaten to restrict offshore talent flow. On the other, generative artificial intelligence is rapidly cannibalizing legacy maintenance contracts. This twin threat is forcing institutional asset managers to completely reprice key players in the sector. To understand the vulnerability, we must look at how these giants operate. Giants like Infosystem and Wipro built global empires on labor arbitrage, managing massive workforces to execute software maintenance and enterprise migration. This offshore-centric delivery model has historically yielded highly predictable cash flows. For decades, it was considered an impenetrable economic moat. It scaled linearly, adding headcount to match rising client demand. The landscape looks slightly different when analyzing high-end engineering services. L&T Technology Services and Tata Elxsi occupy a specialized niche. Instead of standard corporate software, they focus on complex vehicle design, smart medical devices, and automated systems. Their value proposition relies on deep domain expertise rather than pure labor cost savings. That distinction has historically insulated them from standard IT spending freezes. However, recent quarterly statements reveal a system under stress. Revenue metrics across the major IT providers show persistent weakness in discretionary enterprise spending. Financial clients are preserving capital, and billing rates are flattening out. While operating margins have held up due to strict cost-cutting, these measures are temporary. We are seeing a distinct shift where volume growth is no longer driving margin expansion. Over in the high-end engineering space, the numbers are telling a similar story of deceleration. Growth rates at Tata Elxsi and LTTS have moderated relative to their 5-year averages. Enterprise customers are postponing long-term development contracts to focus on short-term efficiency. Despite maintaining relatively healthy operating margins above 20%, their historical premium valuations are being tested as growth slows down. But that is only part of the story. If we look closely at management commentaries, we see a cautious posture. Leaders at Infosystem and Wipro have adjusted their forward growth targets downwards, focusing heavily on deal wins that are back-ended in nature. Their capital allocation is tilting toward dividend payouts and share buybacks. This is a classic sign of mature companies struggling to find high-yield internal reinvestment opportunities. The strategic playbook at LTTS and Tata Elxsi is different. Their executive management is aggressively reallocating capital toward AI-native design frameworks. They are training thousands of engineers on machine learning platforms. However, this shift requires heavy near-term investment in software infrastructure and technical talent. This capital layout is occurring just as international clients are tightening their research budgets. Now look at the broader macro sector dynamics. The geopolitical shift is introducing severe structural risks. Potential restrictions on talent mobility under a new U.S. administration mean onshore labor costs could spike dramatically. If local hiring requirements become more stringent, the traditional cost arbitrage model degrades rapidly. This forces these firms to establish more expensive local delivery hubs inside their key Western markets. But the regulatory landscape is only the first hurdle. The threat from generative AI is far more immediate. Large language models can now automate basic coding, legacy code conversion, and standard software testing. This work was the high-margin bread and butter for offshore developers. Clients now realize they need fewer engineers for basic IT maintenance. This shift is structurally deflating contract sizes. That leads us to a bigger question regarding margins. If contract pricing declines, how do these firms defend profitability? They must either reduce entry-level hiring or cut employee wages. Yet, key talent in complex roles remains highly expensive. Onshore talent acquisition costs are rising rapidly, creating a severe margin squeeze. This leaves little room for standard corporate operations to absorb additional macro shocks. We must also consider client concentration risks. The global financial sector represents a massive portion of IT consulting revenues. When financial firms face regulatory changes and higher interest rate environments, their non-essential IT budgets are the first to be cut. We are seeing a distinct trend where major global banks are insourcing their core software development to run proprietary AI systems. Given these structural realities, forward earnings visibility requires a complete reassessment. The days of treating these stocks as safe haven structural compounders are changing. While their balance sheets remain exceptionally clean with deep cash reserves, their growth profiles have fundamentally altered. Investors can no longer pay premium multiples for mid-single-digit structural growth. We expect valuation compression to continue across legacy services. This macro environment is creating a sharp division in the tech sector. Standard IT services are battling severe pricing pressure. Conversely, niche engineering players with deep automotive and medical solutions retain solid pricing power. This means asset managers must avoid blanket sector purchases. Instead, they need to focus on identifying specific companies with proprietary intellectual property that AI platforms cannot easily replace. Here is our tactical positioning. We are placing legacy providers like Wipro on a strict trim consideration. Their reliance on standard IT maintenance exposes them directly to high margin compression and AI disruption. Meanwhile, Tata Elxsi remains on a high priority breakout watch. We are waiting for its valuation multiples to align with realistic growth rates before allocating long-term capital. Navigating these structural market shifts requires deep, unbiased analysis. The days of simple sector trends are over. To protect your long-term capital, you must track structural cash flows and geopolitical risks. Join our elite community of institutional and professional investors here at SR Money News. Subscribe now, activate all notifications, and leave your strategic analysis of the IT sector in the comments below.